This conference will now be recorded.
All right, welcome. All right, today we're going to talk about commercial coverage parts as part of a commercial package policy, or you might see on your test commercial modules or modular policy. So coverage parts and coverage modules are interchangeable. Your test does go a little crazy with the thesaurus, so be wary of that. All right. The commercial section is about 1/3 of the test, and this will include workers' compensation and business owner policies. So we're probably going to cover about 20% here tonight. All right. So these are the different coverage parts or coverage modules associated with a commercial package policy. The first one is property. It covers the building itself. Crime, again, it's kind of the commercial version of the homeowner's theft coverage. General liability or commercial general liability, you might see CGL. You might just see general liability. You might see GL. So the test might just say CGL or GL. And that's liability associated with a business, just like liability associated with your home. You have a cocktail party, one of your guests slips and falls, and they injure themselves. I mean, your liability policy helps cover the cost for that. Inland marine is kind of the commercial way of saying floater. You know, for the personal lines, increased coverage on your jewelry. If someone steals your jewelry with a basic homeowner's policy or with a standard homeowner's policy, the maximum you'll get is $1,500. And so you can get a jewelry floater or a floater, personal article floater, personal property floater, to raise the limits on the jewelry. So now if someone steals it, you actually get the replacement cost. And that's what inland marine coverage is for a business, giving you better coverage on those high theft items or the expensive items that have limitations on other parts of the policy, like your property policy. Boiler machinery is the equivalent to a home warranty. And so, you know, you get your machinery, washing machine, dishwasher breaks down, you pay a deductible, and someone comes out to fix it using your home warranty program policy. Well, boiler machinery is kind of the same thing for a business. Explosion of steam pipes, steam turbines, generators, boilers, and machinery that, again, are not covered anywhere else. Commercial auto coverage. Now, whether you're in the automobile-related industry, such as a repair shop, maybe a new car lot, or maybe you have vehicles used in the business, like your executives have company cars, and that would be the commercial auto coverage. And then we have farm. Farm is a blend of residential and commercial on one program. Not only do you live on the farm, you also work there. So it's kind of a package. Now, these first items here, property, crime, liability, inland marine, boiler machinery, and auto, you can actually purchase these individually, you know, through various companies, or you can package it up, and that's what your commercial package policy or your commercial modular policy. So again, parts and modules, coverage parts or coverage modules are interchangeable. Sometimes you get only one, like for an automobile repair shop, they just get commercial auto coverage, which covers the repair shop. And so if you bought one module, that would be a monoline policy. So two or more would be a package or a modular policy. So be wary of that terminology that they use on the test. So we're going to start off with the commercial property coverage. So it's covering a building. You know, if the building's more than 6 stories, more than 100,000 square feet, or you do more than $3 million in annual sales, then you cannot cover it under a business owner policy. And so this would be the next option, commercial property coverage. All right. So we got to get the policy parts down. So parts of a policy, you have the declarations. That's the first page of the policy. It tells you who the company is, tells you who the insured is, and gives you some information, kind of like beginning date and ending date of the policy. The insuring clause is usually part of the declaration page, and it just tells you the type or kind of policy you bought. And so you may get a test question that says the clause that describes that you purchased a business owner policy would be which of the following, and that would be the insuring clause. Now, your test goes crazy with the thesaurus, so it might be insuring clause or insuring agreement. All right. Conditions clause or conditions agreement. Now, the condition spells out the duties and obligations of both parts, sometimes called the duties and rights of both parties, or the obligations of each party. different ways of saying the same thing. But the conditions clause basically spells out, this is what you need to do to collect from the policy. Okay. So you have to meet certain conditions. Like if there is a loss, try and protect and preserve the property from any other loss. Notify the authorities if a loss occurs. If it's theft, you have to notify the police. You can't collect from theft coverage unless you actually contact the police. But again, you've got to meet certain conditions in order to collect from the policy. And so I always say you're obligated. You're obligated to provide notice of a loss. You're obligated to provide proof of loss, to basically third-party material backing up your claim as far as how much the loss was and what was damaged. Okay, you have to report that to the insurance company in a timely manner, and it gives the insurance company the option to investigate, settle, and then pay the claim. Right, so you've got to meet certain conditions, and those are obligations in the contract. Exclusions are real simple. It's just what's not covered by the policy. And think of catastrophic exposures, right? Nuclear risk, war, earthquake, flood. Those are commonly excluded from your policies, the catastrophic losses. But you also want to consider, like wear and tear is not covered, right? And intentional acts are not covered either. And so those would be the common exclusions found in most of your coverages. The exception would be in the marine, but we'll get to that. These are the four parts of a policy. Now, you may also have a definition section. And as much as you can Google terms or look up definitions in a dictionary, you want to read the policy's definition, because it's defining this particular verbiage as it relates to this particular policy. Okay, so it's more helping with, it's the legal aspect of the contract that defines what is and what is not covered. That's the definitions page, and it helps explain it. Endorsements, again, this is additional charge for additional features and benefits. These are like the add-ons. And endorsements are really cool because it helps personalize the policy to cater to your insured's unique situation. All right, so that's an endorsement. For those of you that have taken the life and health exam, that would be the equivalent to a rider, additional charge for additional features and benefits. Now, not all endorsements or riders have additional charge, but a lot of them do, because it's going to, in most cases, expand or enhance coverages. All right, and we'll talk briefly about that. In a commercial policy, each coverage part has their own common policy conditions. And the first one is the cancellation condition. This basically states that you, the insured, can cancel out any time. Just give the insurance company proper written notice. The insurance company cannot cancel you out unless they have a legitimate reason. So now for the test, who may cancel a commercial property policy? It's the first named insured. So you might have a couple people that are named, like Bill and Bob own a business. The first one named is Bill. Bill is the person that can contact the insurance company and notify them in writing and cancel the policy. Bob, although named insured, is not the first named insured. The first named insured controls the policy. And that's what you need to understand, especially for this exam. The changes condition basically says who can request changes to the policy on behalf of the insured to the company. Well, that would be the first named insured. So Bill and Bob, right? Bill is the one who can request changes to the policy. And it may not go into effect. I mean, the insurance company will, identify or acknowledge the request and the change of coverage, and they may or may not issue it and make the adjustment. But under the changes, the first named insured can request changes to the policy. Examination of books and records. This is the insurance company side, that if you do insure with them, they have the right to inspect your company's books and records during the policy period and for up to 3 years after the coverage ends. Maybe it's an ongoing investigation, or in some cases, you had a loss during a policy period where you didn't realize it until a year later. That's when you file the claim. And so the insurance company has to be allowed the right to examine your books and records to investigate the claim. Inspections and surveys. This is more of an underwriting function. When you first write the policy, the insurance company may inspect the business, do surveys with workers, maybe management, to get some more insight as far as the risk that we're getting into. Is it a type of risk we want to insure? And if so, what should we charge? So that's inspections and surveys deal more with the underwriting process. Now, it may come into play also at policy renewal, but for the exam, it's typically for the underwriters when they first issue the policy or first underwrite the policy for issue. Right? Premiums. Who's responsible for paying the premium? That's the first named insured. And that means if the policy is canceled, the first named insured gets the premium refund. And so, again, if it's a partnership, there's multiple insureds, multiple named insureds, I should say. The first one listed on the policy is the one that controls it. And that's how you want to understand it. So if it's a partnership, with Bill and Bob, let's say Bill and Bob get into an argument and they want to go their separate ways. Bill calls the insurance company requesting changes. Bob calls the insurance company requesting changes. And as an insurance company, we don't want to get into their grievance. And so it's stated in the contract that we'll follow what the first named insured states and put that into play. Okay. Transfer of rights and duties. This is called assignment. You have a policy on a business that you owe. You sell the business to someone else. Rather than them running out and getting a whole new policy, since you already have coverage, why not transfer the ownership of the policy that you have on your business to the person buying the business? So we basically keep the same coverages, right? Same limits and everything. But the insurance company has to approve this. You see, you have experience running this business and you know how not to have losses. Someone new coming in and buying this business, they may not have the experience that you have in this particular business, or maybe it's the first business they ever bought. And being inexperienced, they're typically going to suffer more losses. And so in this particular situation, when you're transferring the ownership of the policy from one party to another, you can do that with insurance company's written permission. And like I said, it basically allows the insurance company to reevaluate the risk. All right. That's how you want to understand that part. All right. But these are your common policy conditions that are found in each coverage module. All right. So the named insured, remember Bill and Bob are named insured. The first named insured is the one that controls the policy. So that's the person that, if we're writing a business, who do we contact if the premium's late? And that's the first named insured. So it needs to be the name of an individual. The insured is going to be the business. All right. So the named insureds are entities in the business, or the named insured is also the business. All right. But we do need to have someone listed as the contact person on behalf of that business or that commercial policy. And the insured would be the business. In a contract, in the definition section, remember, it helps define the terminology. So when you see we or us, that's defining the insurance company, because we or us, the insurance company, are going to cover you and your business in the event of a loss, a covered claim. Right. And so this is terminology. This is actually in the definition section of the policy. And you may get a question on this. In a commercial property policy, the definition of we or us relates to which of the following. We or us, you need to know, is the insurer or the insurance company. And then you and yours, that's the insured. So remember, insurance is a two-party contract. It's between the insured, the customer, and the insurance company, which is the insurer, right? That's the second party. So the insured is the first party, the insurer is the second party. Anyone other than those two would be a third party. That's why all liability claims are basically third party claims, because it's someone other than you two suffering a loss. So for commercial property policy, there are 4 causal loss forms. Now with the personal line side, you typically just have 3, basic, broad, and special. Well, for commercial property, we have one more, earthquake. It's not in all cases, right? And I'll get into that in just a minute. All right, but again, basic is limited, it's named peril. Broad is named peril, just covers more perils than the basic does. So basic is good, broad would be better, but special would be the best. Because special form or all risk, open peril, has a list of exclusions. So if it's not on the exclusion list, it's covered. Earthquake follows a named peril concept because it names and covers earthquake. That's it. Okay. So, and it can be added to any one of the coverage parts. So if you got a basic form, you could also add earthquake. So sometimes you might see a commercial policy with two causal loss forms, like broad and earthquake. Okay. All right. So basic form. Now this is going to be different than the personal line side. Basic form, like a dwelling policy, only covers fire, lightning, and internal explosion. It's a very limited program, right? But for commercial, the basic property policy provides a lot more coverage than that. All right, so it covers fire, lightning. We actually throw in the wars. Okay, so explosion is part of wars. Fire, lightning, internal explosion, it's the E part. So you want to know what the extended coverage perils are. It's a package of 7 additional perils that can be added to the program. Windstorm, hail, aircraft, riots, vehicles, explosion, and smoke. All right. Now, on a DP1 or a standard fire policy, it's additional charge to add this. All right. A DP2 automatically includes it. But for commercial property basic form, extended coverages are already built into the program on the basic form. So windstorm covers windstorm. It's pretty straightforward. Hail covers damage due to hail. Aircraft covers not that you own an aircraft, but an aircraft damages your house, or in this case, a business. Riots, right? Peaceful demonstration gets out of hand, a riot ensues. That would be riots, or sometimes civil commotion you might see. Vehicles, it does not cover your vehicle. It covers someone else's vehicle, loses control and drives through the lobby of your company, and they damage your company. That's what this is talking about. It's damage to your building, damage to your property because of an outside force. Okay. Explosion, internal or external, and of course, smoke. Again, if there's multiple stories, they typically suffer more losses. If there's a fire downstairs, it'll create smoke damage upstairs. But if there's a fire upstairs, when the firefighters put the fire out, it's going to do water damage downstairs. Vandalism is also included in the basic form on a commercial property policy. On your other programs, the basic, it's got to be added on. Standard fire policy, dwelling policy, basic form, or DP1, it's got to be added on. But with the commercial property basic form, it's built in. Sprinkler leakage, right? Now, to be honest with you, it should say sudden and accidental, sprinkler leakage. In order for your losses to be covered, typically, there's got to be a date and time to when that loss started, and that's what the insurance company is going to look at. Because if there's a slow leak, that's kind of wear and tear, and that's not covered by insurance. Sinkhole collapse is actually covered on the basic form, and this you don't even see on the personal line side. But for a business, yeah, sinkhole. And you might see mine subsidence, where there's maybe like a running water underneath the property, and for some reason the water that was running under the property just seems to dry up, and then it just kind of collapses on itself. That's kind of the sinkhole. Think of a pothole in a larger size. That's kind of what a sinkhole is. Water gets in, kind of creates these pockets because of the vibrations, and then the water eventually finds a way out and disappears, and then it's got all these pockets that now collapse on themselves. That would be the sinkhole. Volcanic action. Now, I'm not talking volcanic eruption and the earth tremors and the lava flow. We're talking volcanic action that drops ash on your building. That's kind of what the volcanic action is about. All right. So it's volcanic action, not volcanic eruption. This one's rare. I doubt you'll get anything on that. But you do want to understand that your basic form, commercial property basic form, does cover sinkhole collapse. That's kind of one of the test questions I've seen out there. So, all right. So now the broad form, let's take a step up. Right, covers everything the basic form covers, and we give you some more. We'll give you limited glass coverage. The broad form, and this includes a special form, we only give you $100 a window with a $500 per occurrence maximum. So if you own this building here and you only got the broad form with no bells and whistles, if the building's destroyed, to replace your windows, you'd only get $500. I mean, that's barely the first floor, right? Maybe one or two windows on the second floor. That's not enough. And so we'll talk about some additional coverage forms that you can add to the policy. But keep in mind that on the broad and special form, there is limited glass coverage. All right. Falling objects. All right. So what that would be, let's say a window shatters and the falling glass damages one of the tables. Okay, that would be falling object damage. So it's not really glass. It's kind of glass coverage because the window broke, but the glass coverage doesn't cover damage to a table. That's a different peril. That's the falling objects, the falling glass damage to the table. And so you need to understand perils are very separate and distinct as far as how it's being covered. So glass covers the glass, the window that broke for some reason. And then the falling objects portion of the policy covers damage to the table because the broken glass fell and broke the table. Okay, two different perils. Weight of ice, sleet, or snow, which a lot of times could cause collapse of a building, is covered. So collapse is covered. And as you can see, that's here. And there could be multiple reasons, but definitely ice, sleet, or snow that causes collapse would be covered. Accidental discharge of water for some reason. It's not sprinkler leakage. It's just sudden, like a ruptured pipe. And again, sudden and accidental. Look for that on the test. You gotta be able to put a specific date and time to when that loss occurred in order for it to typically be covered. Some of the claims in the real world claims, people will, find extensions as to why, this happened. But look for sudden and accidental. Okay. All right. So that's basic and broad, which are named peril forms. Now we're going to rotate into special, and special is all risk or open peril. We cover anything you could possibly think of that damages your building, except for these exclusions. All right. So think of the common ones: earthquake, flood, nuclear risk, and war. They're catastrophic in nature. They do not lend themselves to predictability. Therefore, they are not typically covered by your property policy. All right. Now, some of them you could buy back. Right. You could get earthquake coverage. You could purchase flood coverage. In some areas, large businesses, you can actually buy nuclear risk coverage through the federal government or through the Canadian government and a couple of non-admitted carriers. There is some coverage for nuclear risk, but this is more for larger businesses. But in most cases on your home policy, not going to be covered. Okay. War or act of war is also excluded because war is catastrophic in nature. Wear and tear is not covered because that's just kind of some things they're designed to break down, so you go buy new ones, kind of like your shoes. They're designed to wear out so that you go and continuously buy new ones, and it generates income for that shoe company. That's the wear and tear. And of course, intentional acts are not covered. I mean, you're trying to damage your own property to collect from the insurance company. That could be fraud. And so these two are typically not covered. Not catastrophic, but not covered. Now, earthquake coverage. There's a couple ways of purchasing earthquake. Number one, we just talked about how it could be added to your policy as a cause of loss form, and it would be a named peril form, which covers earthquake loss. Some states or some companies offer earthquake as an endorsement added to your existing policy, or you can buy it as a separate policy, maybe through the earthquake program in your state. And so there's three ways of purchasing earthquake coverage. Cause of loss form added to your existing policy, an endorsement added to your existing policy, or purchase a separate policy to cover earthquake losses. Valuation. Now, for commercial property, if you do suffer loss, it pays actual cash value. Actual cash value for the building, actual cash value for all the contents. Now, keep this separate from your homeowner's policy. Typically, your homeowner's policy pays replacement costs on the dwelling, the house, and actual cash value for your contents. But commercial property pays actual cash value on the building, actual cash value on the contents. Insurance companies require you to carry reasonable amounts of coverage. This is the co-insurance provision. They want you to carry at least 80% of coverage in relationship to the value of the property. And they do give you incentives. If you purchase at least 80% of coverage to the value, there's some incentive called extensions. If you purchase less than the co-insurance requirement, then even in a partial loss, you may actually have to pay more for a claim above and beyond your deductible. And so that's called the co-insurance penalty. All right? And so you got to get this coinsurance equation down. Number one, you got to know the definition of coinsurance. Right? It's to encourage insurers to carry a minimum amount of insurance related to the value of the property. You got to know the coinsurance equation. The amount of insurance you did have divided by the amount of insurance you should have had based on the insurance company's requirement. You take this fraction, you multiply it by the loss. That's how much your company will pay on your claim, minus any possible or applicable deductible. Okay. But again, on the test, a lot of times they use an 80% coinsurance requirement. And so the insurance company is encouraging you to carry at least 80% of coverage to the value of the building. So if this is a $1 million commercial property policy, you should carry at least $800,000 worth of coverage on that building. Okay. And if you don't, and a loss occurs, even if it's a partial loss, that's the penalty. You pay more of a claim. And we'll get into that in just a second. But like I said, if you carry 80% of coverage of the value of the property, you get these extensions. Now, the difference between an extension and an endorsement, endorsements are additional charge for additional features. Extensions are free as long as you have 80% of coverage to the value of the property. Right. So again, there's incentive to carry a reasonable amount of coverage on the property. So this is an area a lot of people do have a tough time with. And so let's kind of run through this coinsurance equation. So the apartment house is worth $500,000. The owner insures it for $300,000. The policy has an 80% coinsurance clause. There's a $200,000 loss. Now, see, how much will the insurer pay? Okay, so we have the items. What we want to do is just plug in the equation. Remember, the amount of insurance you did have divided what you should have times the loss equals how much is going to be paid on the claim minus any possible deductible. Well, we don't have a deductible here. So you just want to plug in the items here. Did divided by should times the loss minus the deductible. Okay, so you did have $300,000 because that's how much coverage you bought. You should have had $400,000. Now, this is where the biggest, I guess this is the most common mistake people make, is they actually put the value of the building under the should category, and that would be wrong because the insurance company says there's an 80% requirement. So you should carry at least 80% of coverage in relationship to the value of the building. So 80% of the 500 is 400. So that's how much you should have carried. So you bought 300, you should have had 400,000. The loss is 200,000. That's a given in the question, and there is no deductible. Sometimes it will give you like $1,000 deductible, but if not, just know that there's no deductible. Okay. And so to put the equation together, you did have 300 divided by you should have had 400. This simplifies to 3/4. So 3/4 times the loss equals, and that's the 150,000. So even though, you know, this person had, there's a $200,000 loss, let's say they had $1,000 deductible. Because they did not buy enough insurance, they have to pay the $50,000 because the insurance company is only paying $150. So this insured has to pay $50,000 plus that $1,000 deductible because they didn't have enough insurance coverage in place. Right? That's the coinsurance penalty. If you don't carry the minimum that the insurance company requires, you're going to have to pay more of a claim. Right? All right. So now let's go into this property coverage form. Coverage A is the building itself. Right? Like I said, for the test, they want you to carry 80% coinsurance. Right? In the real world, it's like 70 to 90. All right. A lot of times in the real world, you're going to insure the building at 100%. Nobody wants to come up short. Okay. But again, you'll get some coaching on that after you pass this test. If you carry 80% of coverage to the value of the building, then you get these extensions for free. All right. Then the 5 extensions, the first one is newly acquired or constructed property. So let's say, you know, you bought the building next door to the one you had. Well, when you buy the building, just like buying a car, you have a certain amount of time to notify the insurance company and add it on. And in that interim period, we're going to go ahead and give you $250,000 worth of coverage for that newly acquired building, right, or newly built. Okay. We'll also, not only will we give you $250,000 for the building, we'll give you $100,000 for the business, personal property, or contents in the building that you just bought. Okay. A lot of times on your commercial property, it only covers property in and around the building within 100 feet of the building, or I should say 100 feet of the premises. So if you're taking your laptop or maybe some inventory because you're going to go to a show and display it, once you leave 100 feet from the premises, it's not covered. And so one of the extensions is we'll give you up to $10,000 worth of coverage for some of your business personal property that's off premises. So that's kind of nice to have. Otherwise, it won't be covered once you left the office, with that company laptop and something happens to it. Signs, typically attached to the building, will give you $2,500 for that sign. Remember, this is just an extension of coverage. You can get more. We'll get into that. And for certain valuable papers and records, like maps, manuscripts, drawings, mortgages, and things like that, you may want some coverage. There's a limit on here. You don't need to know it. The most common questions you're going to get on these 5 extensions are, what's the value of newly acquired or constructed property? How much contents coverage do you have in that newly acquired building? And how much do you get for property off premises? The $10,000. Okay, so $250,000 for the building, $100,000 for contents, and $10,000 for business personal property off premises. Okay. Now that's just covering the building. Anything bolted, welded, nailed, attached to the building. The business personal property, that's included, but again, it's only in and around the building within 100 feet of the premises. So this is your building, right, and your business personal property. So if it's an office building, doing retail service, it's going to cover your desk, your computers, maybe any inventory and stuff that you have on premises only. And then you have coverage C, which is personal property of others. You might want to say there's like Bailey's coverage, like maybe it's a dry cleaner where people drop off their clothes for you to clean, and there's a fire. We're going to replace their clothes on an actual cash value basis. It could even be a veterinary hospital where people leave their pets overnight and there's a fire and their pet's destroyed by the fire. It's going to pay actual cash value for the pet. And sometimes you'll see this as Bailey coverage. You have temporary possession of other people's property. Right. Do not confuse Bailey coverage with inland marine. Bailey coverage is more the lower ticket items. Right, a couple shirts at the dry cleaner. That's not very expensive. Inland marine coverage covers you leaving your 5-carat ring at the jewelry store to be resized, and then a loss occurs. So that's a whole nother world. Okay. Now remember, commercial property gives you actual cash value for the building, your personal property, and also actual cash value for other people's property under your care. That's coverage C. So actual cash value on everything. All right. There's coverage forms. There's actually 13. The first one we kind of talked about, that's the commercial property and business personal property coverage form. Builder's risk covers a building that's being built. So it covers everything that you're purchasing that's being installed in the building, the girders, the beams, the wood, the flooring, the tile, the air conditioning units, but it doesn't cover the builder's tools. Builder's risk, like I said, covers everything that's being installed in the building. There is no liability coverage here, right? Because the only people that are in that area building that building should be workers. They're covered under workers' comp. Okay. So there's no liability. This actually includes theft of a building or part of a building for builder's risk. But like I said, it does not cover the builder's tools. The builder should have their own contractor's equipment coverage to cover their tools. As a business, you can get some consequential loss coverage, which is business income and extra expenses. You can get them both, right? Or buy them separately, depending on the type of business. So like if a restaurant burns down, then they want business income. Because if they have a fire and they're closed down, then they're not generating revenue. So after 72 hours, the insurance company can pay them the lost revenues, the lost business income that they would normally earn if they were open for business selling food to the public. Okay, but because of the fire, they're not. And so that's what business income coverage is all about. All right, make sure you get the business income formula. It's in the playbook, all right, that I have on my site. Extra expense coverage covers the additional money that's needed right at the time of a loss to get up and running, and possibly even at another location. So whereas business income has a 72-hour wait before we start paying lost revenues, extra expense coverage begins immediately at the time of the loss to get you up and running as soon as possible after a loss. Right? Now, a restaurant may not need this, but if the restaurant, this covers the lost revenues from the restaurant. But let's say in the back end of the restaurant, they had a catering business and they had quite a few orders. They're pretty, high-paced catering company. Then they might want extra expenses, because if the restaurant burns down, well, then the restaurant's not generating income, but that catering company, they still got to meet their orders. And so the extra expense coverage could get them the money to get a location, get equipment, and get their catering business up and running as soon as possible after a loss. Okay, so that's in some case you might want both. Okay, so it depends on the situation. But business income extra expense coverages are consequential or indirect loss coverages. All right. Glass coverage. Remember on the broad and special form, you will only give you $100 per window with a $500 max. That would be more than one side of this building right here. You own this building and there's a major loss where you lost all the windows from, maybe a sonic boom too close to the building, caused the windows to blow out, and you get $500 to replace all the windows on this side. That's not enough. So by adding glass coverage, we can cover all the windows on an all-risk basis. Okay. So, oops, sorry about that. Come on. There we go. All right. So that would be the glass coverage. Condominium association coverage covers the exterior common grounds for condominium association. The hallways, the stairways, the carports. That's the association coverage. The exteriors of the building. And then the unit owner's coverage covers the interiors, right? So that would be, like the kitchen cabinets and things like that, the bathtub. And so if the association has both and you own a condo, you really only need an HO4 because they're covering the exteriors and interiors. Right? But most condo associations only have exterior coverage of common areas. And so then you need that HO6 because now you are responsible for the kitchen cabinets, the bathtub, and the fixtures. Leasehold interest covers for some reason you had a loss, you had to break a lease and maybe move to another location. So it can cover that, number one, but it also can cover the increased rents. Because, maybe when you bought in early at this location and then a fire destroys it and they're not going to rebuild. That means you got to move your business elsewhere. Well, because rents have gone up in the area, to find another comparable location, the rents have gone up. Well, your insurance company's only going to pay the rent you were paying. We're not going to pay any increased rents because it's a gain for you. And so the leasehold interest coverage can actually pay the increased rents to put you at another location and getting up and running. Okay. And legal liability covers losses that your company is legally liable for, associated with the property, by the way. Now, don't read too much into this one. This one's really, it seems more of a definition versus a question on the test. All right. All right, so that's the property. Let's talk about the crime, okay? So you own a building, right? You want to cover the building, but your property policy only covers damage to the building. It doesn't cover theft coverage at all. So neither the commercial property basic, broad, or special form cover any type of crime or theft loss. And so you'd have to purchase commercial crime coverage. Now remember, you can buy it as a separate policy, or you can get it as another coverage part on your commercial package policy or your modular policy. All right, so the four parts of the policy. Coverage A is employee dishonesty. This is if your employee does something wrong. That means they steal from you. All right, they got a hold of your company's checks, money orders, forged and altered them, and sent them to other people. They stole your money or securities. They stole your inventory other than money and securities. So that coverage A is your employee did any of these. All right. Coverage B is an outside party broke into your company, stole your company checks and money orders, forged and altered them, and sent them out to other people. All right. So it covers some outside party stealing it, forging, altering them, and sending them to other people. It doesn't cover your company receiving a forged or altered check. Okay. It's the other way around. And that's outside parties. Coverage C is theft of money and securities from outside parties. Because again, if your employee stole your money and securities, that's coverage A. And then coverage D is theft of property such as inventory other than money and securities from outside parties. Because remember, if your employees did that, that would be under coverage A. To be honest with you, coverage A is a fidelity bond within the commercial crime program. And fidelity bonds are designed to cover employee dishonesty. Right? So like I said, anytime your employee does something wrong, it's coverage A. And if it's something else from an outside party, that's coverage B, C, or D, depending on the type of loss. Now, theft of money and securities and theft of property other than money and securities, there's some additional coverage parts here because it could be on premises or off premises. So if you're on premises, right, then they basically stole from a custodian, or they could have threatened a custodian. If it's off premises, then it could have threatened or stole from a messenger. Right? So there's different terminology there. And so read the question carefully. Did the loss occur on site, in and around the building within 100 feet of the premises, right? Or off site? Okay, so that would determine whether it's on premises or off premises coverage. Terminology for theft coverage. Theft is any act of stealing. Theft has the broadest definition, and you do need to know that. That's very common on the test. Burglary covers damage to the entryway and exitway of a burglar, as evidenced by visible marks of forcible entry. So if you only had burglary coverage, and you didn't have theft or robbery or anything else, then if they broke into this window, stole your stuff, and took off, burglary coverage would only cover damage to the entryway or exitway of the burglar. It wouldn't cover the stuff that they stole. Again, just like perils, everyone is separate and distinct. All right, so you got to keep an eye on that. Okay, and then robbery. Okay, so burglary is breaking into closed premises, so you want to have an understanding that there's no one around. Robbery is where they're threatening someone, threatening to injure or murder someone and take property from them. So anytime someone's being threatened to take property from them, that's robbery. Breaking into closed premises, that's burglary. And of course, theft, that encompasses all. Theft is any act of stealing. Covers burglary, covers robbery. It even covers safe burglary. Okay. When you see in the movies, they've got those high-rise office complexes, and the executive goes to this picture frame hanging on the wall, and they kind of swing it open because it's on a hinge and there's a safe in the wall. That's the safe burglary we're talking about. Okay. And that could be covered here. All right. This overlapped. I apologize. Whoops. I was changing the format on this one. So, come on. There we go. Okay. So there's two ways of writing crime coverage. You can't see it right here. Loss sustained and discovery form. For those of you that are registered, I recommend, I did put that webinar, I recorded it 2 weeks ago, and I did post it on my site. So when you log in, then I explain the difference between loss sustained and discovery form. But there's two ways of writing commercial crime coverage. The first one, loss sustained covers losses that occurred during the policy period, and even if a claim is filed up to 1 year after coverage ends, that's loss sustained coverage. And then discovery form, you can't see it here, I apologize. Discovery form is where the policy in effect, when the claim is filed, is the one that pays for it, which means something could have happened before you bought the policy, and if the loss happened within the retroactive date, this policy can still cover it. All right. So that's property, that's crime. Let's go into general liability. Now, it's general liability. You might see I keep doing that, CGL, commercial general liability, CGL. You might see general liability, or you might just see GL on your test. 4 ways of saying the same thing, which is liability for a business. All right. The parts of the general liability policy, or CGL, coverage A is bodily injury and property damage to others. So remember, this is liability. L for liability, think L for lawsuit. Maybe your customer got injured, or in your business, you damaged someone else's property, accidentally, of course, right? That would be coverage A. Coverage B would be personal and advertising injury. Maybe you have a marketing campaign and knocks your competition. They lose money and they sue you because it's a false statement that you made in your advertisement, and it costs them money. And so they're suing you for the lost income. Medical payments, again, this is the ambulance ride. One of your customers slips and falls in a lobby of your company. Medical payments covers the ambulance ride. And then because they're not working and they're, recovering from this injury, that's the liability coverage A, bodily injury, property damage, or I should say the bodily injury portion, covering their medical bills and lost wages. All right. And every liability policy that's out there has a section called supplementary payments. It's not that prevalent, not that common, but this is the big thing that people don't realize. When you're buying liability coverage, you're not buying just the liability limits to protect you in case you injure someone and they sue you. You're also basically purchasing the insurance company's legal defense team to defend you in a lawsuit against you. And that's part of supplementary payments, right, to defend a claim. Because maybe we, the insurance company investigator, we think, maybe this is a frivolous lawsuit and we're going to go ahead and defend it because we feel that we can win it, right? Or what we might want to do is step in and offer a settlement, right? They're suing for this much. Why don't we offer them a settlement for a smaller amount? Because they might just take that money and disappear and the claim is over, which saves the insurance company a lot of money, okay? And so that's part of supplementary payments. Another thing that's part of supplementary payments is if we need you to miss work to help us with this case because you were in the store and you watched, that customer go down and slip and fall in the lobby, then we may need you to miss work to help us out. And under your general liability policy, this supplementary payments pays up to $100 a day. That's $100 a day in lost wages for you to assist us with this claim. And it's only going to pay $100 a day. Your employer, since kind of you're helping defend them and keep their insurance costs low, possibly, they should make up any difference. So, but just know that for the test, right, supplementary payments can pay employees up to $100 a day to miss work to assist with the case. And this got jumbled up too. There's 2 ways of writing commercial liability coverage. Just like commercial crime, you have occurrence-made coverage and claims-made coverage. Okay, again, I'm going to recommend that you check out the other webinar. It's a recorded webinar on my site. It does have the information on it. So, and I do go in a lot more detail to help you understand that. Inland marine. So this is equivalent to your floaters on the personal line side. Someone breaks in and steals all your jewelry in your house. You get $1,500 maximum for theft of jewelry. So if your jewelry is worth more than that, you can get a personal property floater or a personal article floater, which is going to raise the coverage on your jewelry. So if someone steals it, you actually get replacement cost coverage. All right. Well, guess what? Same thing for a business, except instead of calling them floaters, we call it inland marine. All right. And so it is all risk coverage. All right. So even though a commercial property policy is a named peril program, this is all risk. Okay, it is worldwide coverage because remember your commercial property policy only covers anywhere in and around the building within 100 feet of the premises, but inland marine is worldwide. And instead of actual cash value like your commercial property policies, this will cover it on a replacement cost basis. So. I've got a picture of a jewelry store here because your commercial property policy, even with inventory, it's only going to give you a certain amount of coverage on inventory. Since you have some high theft items, you want to get inland marine to increase the value of those high ticket items in the event of theft or other losses. All right. And that's replacement cost basis. I do have filed and non-filed, but I doubt you'll see that on the test. You may get that, but on the personal line side for jewelry, you'll see scheduled and unscheduled. And scheduled, whenever you see scheduled, think of you need a list. As an insurance company, I want an itemized list of the jewelry you have with appraisals that are telling me, substantiating that you did have a 4-carat stone This is the cut, the clarity, and the quality of that stone. This is the setting that's in. This is the value, okay? Replacement cost value of this ring. And so we need you to schedule your items. That would be equivalent to a filed form. But most cases you'll see scheduled or unscheduled. So scheduled is I need a list. Unscheduled means I don't need a list, but if a loss occurs, you do have to prove that you had it. All right. Another thing about inland marine coverage, especially like jewelry, it covers what I call the 3 C's: care, custody, and control of other people's property. So this jewelry store, you might have people walk by and you encourage them, hey, do me a favor, that's a beautiful ring there, but it's a little dusty. Would you mind if I go ahead and put it in our little washing machine back here to kind of clean it up for you? Because that's a beautiful ring. It shouldn't be dirty like that. You want to, it'll bring out the shine a little bit more. And so they leave it there. They go shopping. When they come back, the jewelry store burned down with a ring in it. And that's what we call the 3 C's: care, custody, and control of other people's property, such as that situation I just gave you. And so your inland marine policy can cover other people's property under your care, custody, and control. Now, this is different from Bailey's coverage. Bailey's coverage does cover care, custody, and control over other people's property. But remember, Bailey's coverage is low-ticket items like dry cleaners. You had a couple shirts at the dry cleaners that got destroyed by a fire versus a 6-carat ring that was left to be resized here at the jewelry store. And so Bailey's coverage is lower ticket items. Inland marine is the high ticket items. All right. Boiler and machinery is another type of coverage, and this is equivalent to your homeowner's home warranty. When you buy a new home, they encourage you to get the home warranty to cover appliances in case they break down, dishwasher, right, washing machine, any of your appliances or some of that break down. You pay a deductible, someone comes out and fixes it. Well, we kind of have the same thing for a business, and that's what boiler and machinery coverage is all about. All right. It's equipment breakdown coverage. You might say boiler and machinery or B&M coverage, or you might say equipment breakdown coverage. Now, it can be added to your commercial property policy part. Now, whereas your commercial property policy, I keep emphasizing, is an actual cash value valuation, but boiler and machinery is all risk coverage. That means we cover anything you could think of except for this list of exclusions. And the biggest exclusion is wear and tear. Now, the test may not say wear and tear. They go crazy with the thesaurus. Could be deterioration, erosion, corrosion, inherent defect. Inherent defect is tools need to be replaced because they wear out. That's an inherent defect, and that's not going to be covered. And so inherent defect is the exam's way of saying wear and tear, which is not covered. They do provide coverage on a replacement cost basis. Okay, all risk replacement cost basis. And keep in mind, most of your premium for boiler and machinery coverage actually goes towards inspections. Routine physical inspections to, replace worn out fittings to keep from a major catastrophic loss occurring, like an explosion. And so, yeah, majority of your boiler machinery premium goes towards inspections to prevent loss. Kind of a proactive approach, which is really good. Okay. Commercial auto coverage. Again, you have a personal auto, and you may be in the business of either selling autos or, maybe an auto repair shop. Right? And so, or maybe you have a company where you have vehicles for your executives to use. And so we're looking at commercial auto coverage. And we go into, here we go, the parts of the policy. So when you think of auto insurance, right, think of your personal auto policy. You have liability, which is coverage A. It's broken down into bodily injury and property damage. And this one, you want to get some reasonable limits. Right? You don't want to get the minimum like you do in your car. If you really want to save money's tight, then you get the minimum liability limits that you need to register that vehicle and drive it in your state. But for a business, you want higher limits. You have more at risk. Okay. And so again, it's based on liability limits you choose. Now, the medical and uninsured motorist on your personal auto policy, they're automatically built in under your policy, and your clients can choose to not take the medical. They can choose to not take the uninsured motorist. Right? So these are built into your personal auto policy, but they can elect not to take it. Now, for commercial auto, it only comes with liability. And did you want to add medical? Did you want to add uninsured motorists? Because they're not automatically par for the course. They're not automatically part of the program like a personal auto policy. Right? The reason being is if you only have your employees driving the company cars, then your employees are covered under workers' comp if it's work related. So if they get hit by someone who doesn't have insurance, their workers' compensation will take care of the employee. So you wouldn't really need this, okay? And so that's why these are optional, because your employees are covered under workers' comp. Now, if you do have a company car that your executive, drives and takes home, so not only do they use it for business, but they also use it for non-business purposes, then you may want to add this to the policy to protect them when they're not on the job, okay? So that's an avenue there. Now, coverage D, physical damage. This covers damage to the vehicles. Right? Now, we have collision, which is damage to your vehicle because you caused it. Other than collision, or actually now for commercial coverage, they call it comprehensive. Okay. For personal lines, the physical damage is collision and other than collision. But for commercial, the physical damage is collision and comprehensive. So collision is damage to your vehicle because you caused it, like you drove into a tree. And then comprehensive is there's damage to your vehicle that you did not cause, like a tree fell on your car. Okay. Now, I got to add one more because for the physical damage portion of a commercial auto policy, there's three categories. Collision, which we just covered. Comprehensive, which we just covered. But there's another one called specified cause of loss coverage. And this is basically giving you named peril coverage for your commercial vehicles. So it's very limited. It's definitely going to cut your costs, but you can mix and match it. You can get collision and comprehensive, or you can get collision and specified cause of loss because it covers less, and so therefore it does lower your premium. All right? But some people want to take that that risk, and they feel that things like that don't happen to them. Okay, but it's offered. Right. So commercial auto, think of vehicles used in the business versus business auto, we're in the auto-related business. In this case, a repair shop. Okay, so that's kind of the difference. Your test may change it up, but just know we're covering vehicles used in the business, or we're in the business of dealing with vehicles. Okay. Now, for commercial auto, we have symbols. It helps define the coverage and define the vehicle. These are the common signals found on, or symbols, symbols found on the test that we've seen. All right. Symbol number one is any auto. This is the most comprehensive symbol. If you are the owner of a company and we basically classify you or your vehicle as symbol one, it basically covers you covering any vehicle. That means you driving your vehicle, you use one of the company vehicles, you borrow your employee's vehicle, you rent a car. That covers any vehicle that you use, unless you stole it. That's not going to be covered. Okay. Symbol number four is owned autos other than a private passenger auto. You'll just see that. So for or faux, I joke around, faux owned autos. Just drag out the faux, FO, faux owned autos other than a private passenger auto. You'll see that and you'll remember that way. Okay. So I apologize. I don't mean to offend anybody, but that's probably one of the easiest ways I can help you understand it and remember that just to get through this test question. Symbol 5 is for states that have no fault. So F for 5, F for fault. Okay. 4 begins with an F, but just, faux. So yeah, I'm ebonically challenged. All right. 7 for specifically described autos. So 7, symbol 7, 7 begins with an S. S for 7, S for specifically described autos. Okay. 8 is for hired autos. And so the best way to understand this is let's look at pizza delivery. Right. I'm in Northern California. We have Round Table Pizza. We have Domino's. Okay. Round Table Pizza, they actually have their own delivery trucks to deliver pizza. And so those are owned autos. All right. Now, Domino's, the employees use their own car to deliver pizza. That's actually symbol number 9, non-owned auto. So a non-owned auto is employees using their own car for or in the business. That's symbol 9. So Domino's, they have non-owned auto coverage. Roundtable, because they have their own trucks, have their it's probably symbol 4 because they're some of them are trucks. Okay. So now let's say the Roundtable guy goes to work to deliver pizza, and the truck that they're using is broken down. So they need to rent a car to deliver pizza. That would be symbol number 8. That's the hired auto, where we're renting a car to use in the business. Now, keep that separate from you have an executive. And with this executive, you give them a company car to use. And, business, non-business use of that company car is covered. But your executive then flies to a Midwest state to go to a convention for your company, and they rent a car. Now, your commercial auto policy doesn't cover that. Your commercial auto policy covers the vehicle that you gave to them for them to use in your business. It doesn't cover them going someplace in another state and renting a car. Now, that's not a hired auto, because a hired auto is a rental car that's used in the business. This is they renting a car to get around town, to go to a convention, or maybe take a vacation. And so to cover that executive in that situation, you need to purchase something called drive other car coverage. Kind of an executive perk to cover your executives if they do take a vacation and they rent a car on vacation, and you're extending coverage to that rental car for recreation. Okay, so that's different than symbol number 8. I just want to emphasize that. Motor carrier coverage. Just like on the personal auto side, there's minimum liability requirements that you have to meet in each and every state. For motor carriers, same thing, depending on what they're transporting. So a standard liability limit is $750,000. And where we've seen this on the test is, you have a moving company. Maybe there's a moving van and they're transporting people's property from one location to another. They need a minimum of $750,000 of liability for that particular type of risk. Okay. Certain hazardous materials, $1 million, but explosives, okay, then you need a minimum. These are minimums, by the way, of $5 million. All right. So if you have a motor carrier, like a semi-truck transporting explosives, the minimum liability required would be what? And it's $5 million. So you either get the moving company, they need minimum $750,000, or you get the transporting explosives, and that would be minimum $5 million. And you can always buy more, just like on the personal line side. You can always buy more. All right. And the reason I'm emphasizing this is actually federal. Okay, under the Motor Carrier Act. So this isn't state. This is the federal minimums, and this is what they may ask you on your exam. Farm coverage. Remember, it's a blend of residential and commercial on one program. Not only do you live there, you also work there. So it is a blend. All right. Under the property coverage, we cover your house. We cover your other, any other structures, just like your homeowner's policy. Coverage A covers the house. Coverage B covers your separate garage or your fence. Coverage C covers personal property, which is your contents. And coverage D covers the cost to put you up at a hotel if your farmhouse burned down that you were living in. And you need a place to stay until they rebuild it and you can move back in. And so this is very similar to a homeowner's policy as far as coverage A, B, C, and D. Okay. Where it does shift, right? There's some property coverage for E and F, right, which covers the structures on the premises and the farm machinery. But I want to jump into the liability. So farm liability, there is bodily injury and property damage to others. There's personal advertising injury because there's a farm. You may have some commercials, to market and advertise your farm. And you might knock your competitor and you might get sued, and this is where that's covered. And coverage J is, again, medical payments to others. And this is on the farm side, not necessarily the personal side. having some friends at your house, your ranch house. But this is, medical payment. Someone's injured associated with the farming side of your property, okay, or the business side of your property. Okay, so at best you may get 2 farm questions in most cases. All right, just know that it's a blend of residential and commercial on one program. Right, because like I said, not only do you live there, you also work there. But another thing you need to understand is your farm coverage covers Farmer John's tractor as farm equipment. But it won't cover Farmer John's pickup truck that he drives to the store to get groceries. That would be covered under his personal auto policy. All right, so be wary of that one. All right. With that, I'm going to open it up. Do you guys have any questions?
How you doing, Lauren?
Good. How are you?
Good. Yeah. So I'm one of your students. I signed up for your classes and I'm reviewing stuff online. And then I did take the exam like 2 weeks ago. Then I had COVID, and then that threw me back. But I'm just slowly getting back to because I got 104. I need a 111. This is Jubair, by the way. And then I scheduled it later, and then I was gonna do it that week. Then after I got COVID, I got sick, and I just I didn't pay attention to the notes, but I'm slowly getting back to the to my grind.
Got it. That's okay. I'm here for you, man.
Yeah, thank you so much. Appreciate it, boss.
You got it. Any questions you have, or anything you want to?
A
little more
it's been a while since I logged in. I just logged into your class today, just to go over things. I have to go look over my notes and I'll reach out to you. I mean, you have a webinar every week, right?
Yeah, every Wednesday's for the property and casualty. You got it.
Yep. Yeah. I'll talk to you then, or I'll email you. And yeah, I just want to say thank you.
You got it. Thank you.
All right, bud.
Right.
Thank you. Have a nice day.
I'm glad you're doing well, man. Good job.
Thank you.
All right.
Thank you.
All right.
All right. Bye. Take care.
You too. All right. All right. If you haven't registered, you're looking to get into my programs and access some additional information above and beyond this webinar, reach out. Go to lgdstudy.com. This is a landing page to register. Sign up for 60-day access. You will get a reply email with your login information. It will send you to lgdconsulting.com and give you the steps on how to log in, how to access it, and it's kind of instructions on how to study. So I'm going to change a little bit of how you study for an exam. My exam questions, I do have sample test questions, but the correct answer is already highlighted. I don't want you to test yourself. That's not the thing to do with this particular exam. And so you want to associate, when you see this question, this is the answer you want to associate with it. You got to get that concept down. The verbiage may change, but that concept or that relationship between that question and that answer doesn't. And so I want to make sure you get those associations down. So as you study, if you do have questions, do not hesitate to reach out. You can email me questions as you go through my material. If you need clarification in certain areas, even if you've just taken the test and it just didn't do very well, get me your results so I can coach you on areas to focus on and give you, a little bit more specifics of where to go to get those details to kind of fill that void and go take and pass that test on your next attempt. So, yeah, with that, thank you for hanging out with me. Hopefully you learned some things. Good luck on your test, and hopefully, everybody stay safe. All right, take care.